right. Happy Monday, Vince.
How's it going?
Good. Thanks for following up with me. As I said last week, I wanted to steal this time. We had pre-booked for another meeting to get you on another Zoom because after our YouTube video that we put out a week ago, so last Monday, we did get some questions from Instagram, Facebook, our clients emailing back after I had sent it out in a mass mail, just wanting a little bit more information on certain topics. And there was a lot of questions that were repeated. So we obviously didn't address them in the first call. We probably went off on a tangent. So I jotted down some notes based on the conversations I've had with people this week, as well as yourself, so that we can address some of those commonly asked questions today in just a brief little follow-up.
Yeah, let's do it. Awesome.
So just as a reminder, what we talked about last week, the first thing that we talked about, we talked about the Bank of Canada announcement that was a few days before we had filmed that, where they had just kept the rate flat. And then we quickly moved on into talking about maturities in 2023.
Right.
So we talked a little bit about how 2023 is a huge maturity year. And this is really where I got most of the questions. Is this where a lot of people had questions for you as well?
Yeah. Yeah, we got a lot of questions on the maturity side of things, and it did hit home. So I was kind of happy to see, because it is an important time in people's mortgage life, if you will. And I think people need to take it more seriously and really need to realize that they do have options, and that the ball's in their court, not in the bank's court.
That's right. And I think a lot of people felt like because there's a lot of unknowns in the market, or they're not well versed, all they hear is like scary things happening. They feel like they're at the mercy of the bank. Like, oh, if the
Right.
bank's willing to renew me, I've just got to stick with them. I don't want to open that can of worms kind of thing. But I did have a very interesting question that I wanted to ask you. I did answer it for the client, but I wanted to hear your
Okay.
side of it too, because sometimes you bring a little bit of a different perspective. I always like to hear. So there's a lot of maturities in 2023. What? Oh, sorry, just a call from our underwriter there. I'll have to call her
That's all
back
right.
after this. With the large number of maturities in 2023, we talked a lot about how that will affect the person with the maturing mortgage, but how will all of those maturities affect the housing market? Buying, going out there and looking for houses, will it have an effect on prices, on inventory? What do you think?
I would say really hard to say, because at the end of the day, it's going to come down to whether people want to stay in their homes or not, and if they can afford the payment. Now, there's going to be a level of payment shock, right? We said 80% of those people who are coming in for maturity are in fixed, so they're definitely going to have a payment shock. Could be somewhere in around 55 to 60% of a payment shock. Or a lot of these people, if they take the opportunity to review their overall financial picture, they might actually put themselves in a better position by refinancing their total debt into their
Right.
mortgage, extending the amortization, and making something more affordable for them, right? So, and the other thing too is we always have to remember, for an effect on the housing market, there has to be a buyer and a seller at the same time.
Right.
So the transaction occurs with a buyer and a seller, or you have an influx of new first-time buyers, which we may see this year. But I mean, I don't think that the number of renewals will have a massive impact on the market up or down. I think that that's too hard to predict.
I agree. And I think that's why in our initial meeting, we talked about it more from the perspective of the individual who needs some help with their mortgage maturity, or us as a team working through our process.
Right.
I did mention to the person that asked this that I do think that there will be some people who will be in a position where they will have to sell their home because that payment shock, it may be outside of their affordability, and therefore they decide to sell and maybe downsize to stay affordable. But I think that would really be a last resort. And I don't think that's going to affect enough Canadians that it's going to make a massive difference on the amount of inventory out there. There could be some that you're seeing come up because of that. But I think more people will just be interested in figuring out a way, by talking to a mortgage professional, how they can continue to afford this. To your point, maybe a debt consolidation would be in there. And I think really it's just going to keep us busier with maturities versus a big effect on buyers. So I think if you're still planning to buy, you should probably still be out there trying to be competitive, because There's not a lot out there yet. We do see more popping up, but you definitely do need to stay on top of the inventory out there to be able to find, your perfect spot. So,
Yeah, and I think also people will find efficiencies, right, where they need to. So, for example, if they have to cut back in something else in order to make their mortgage fit, it will do that. I mean, Canadians have been proven to do that, because the asset of owning a home is highly coveted. So, I think totally last resort would be selling the house and renting. Most people who are in a home now are gonna try to stay in it and maybe cut a vacation, or maybe we've seen people have their parents move in with them,
yep,
or they make other alternative arrangements,
rent out their
maybe
basement.
rent out their basement. Yeah, we've seen that. So a lot of things will occur in people's decision making, that will probably keep them in their homes.
And I also think too, a lot of people, even if you were in a fix or you haven't really had to stay too dialed in to the rate changes over time, those of us in variable rates, we've absorbed the shock a little bit by little bit over the
Right.
last year. These individuals in fixed haven't had to worry about that, but they've been aware of it. So I'm sure they were well aware that coming up for maturity this year, there was going to be a bit of payment shock. And many of them, I would hope, would have either already reached out to a mortgage professional to look at these numbers or have started making lifestyle adjustments, bracing themselves for this next step.
Most people have done the calculator online.
Yeah.
We've seen
Yeah.
it. I'm a lot of most of the time we're talking to people who are coming up, who have a mortgage coming from maturity, and like, listen, I already know rates are not where they were a year
Yeah.
ago. They've been prepared for
Right.
that. But of course, then we're refining numbers. We're looking at a global picture, so we're getting into more details with them. But a lot of people have that in their mind already. Yeah.
Yeah. So great next step. We were talking a little bit about reaching out and saying, listen, I already know they've started the homework, but they reach out to us and they want to go through kind of a process to see, like, they've gotten their maturity notice from their bank and they reach out to us and they want to know, like, am I getting a good deal? Like, is there
Yeah.
anything better out there? So some people had questions about that process. So a big one that we got was, oh, I think I'm just going to renew because I don't want my credit to take a hit when you pull my credit again, because you'll probably have to do that when you're looking at options for me. So, how badly does it hit your credit if we're having a look at it?
Yeah, I would definitely tell anyone who thinks that, definitely we definitely just spend some time to educate them on what it means to pull a credit and what impact it has. When we're pulling a credit, we're pulling a FICO score 8, which is an Equifax, a specialized score for mortgage underwriting purposes. It is not the same as if you're pulling a score for a credit card, or a car loan, so it
Right.
affects your score differently. It is a hard hit, but at the same time, it has very little impact to the credit score, and certainly doesn't and shouldn't negate you from shopping around and looking for a better offer. So absolutely, unequivocally, no reason to sign with the existing mortgage lender, for fear of having an impact on your credit score. Like, it's totally worth it. So if someone thinks that, we should definitely have a conversation. We can show data. We have it written from Equifax as well, very clearly what Equifax FICO score 8 is, and you can look it up online yourself as well. So very, very clearly, it's really important to take that opportunity to have a look at what is out there in the market. Remember, you're a free agent. I keep saying this to everybody. You use the same thing. You're a free agent. It's time to have a look and see if the current lender is giving you a fair shake. If they're not, then we can hold them to account. We can obviously look out there, but also if they are giving you a fair shake, then at least right?
Exactly. Exactly. So at maturity, you're going to pull credit score. What else are you going to need to see what other options are out there for an individual?
So first of all, of course, is that consent form that allows us to pull the credit score, allows us to, review your overall financial picture and give you the unbiased advice we're going to give you. So that's sort of like, it's a one-pager consent form. Most of our clients already know about it. It's a quick e-sign. We're going to pull the score, and review the credit report actively with the client. And we will update our application. If you're a new client to us, we'll definitely create a new application and collect some information such as income information. So that's going to be really important, because there's no sense in discussing an option if you can't qualify for an option, right?
Right.
We're not into over promising and under delivering. We really want to manage expectations, and what we need in order to do that is information. So we'll need income information from a client. We'll need information on the value of the home and the current state of the home. We'll need information on other expenses tied to that home, such as property taxes or condo fee. And we'll need information as to other kind of debts that they may have or other assets they have. So that could be if they own another property, like an income property or a cottage. There's a mortgage on that property. Some of that stuff shows up on the credit bureau, some of it doesn't. So we'll get that information. So it is a full-on application. But
It's honestly the same process as if we were doing a brand new pre-approval. And I've had people say, "Oh, no, I don't need to send you all this. This is just like for my maturity." And I've explained to them, we can't tell you what your options are unless we know really where you fit, and then we can give you compare apples to apples and oranges to oranges. And we did talk about in the last video a little bit that, there is a big element of honesty here where if you are in the right place, we're going to tell you that. We're not going to move you just for the sake of moving you. But you do have to have a little bit of skin in the game and do a little bit of homework to get us those income documents, mortgage statements, whatnot that we ask for, just so we can look. And at least at the end of the day, you've had a professional look over it, and you've got peace of mind for that next term that you're in the right place. And I think that causes a lot of people just to feel a little bit more at ease, know that they've at least done the checking, and they can move forward with confidence, even if they're just staying right where they are.
yeah,
Um,
it's like doing the purchase. However, the only thing we just don't need is we don't need the down payment information. So
that's right.
that's otherwise we pretty much need the other info that we've requested in the past, some of which we may already have on file and just need updated. Some things have changed for people, right? After 3 years or 5 years, they've got a new job or they've got promoted or they've changed careers. So
Yeah.
we do need that information. And again, it's always just about making sure that whatever we're going to recommend is going to be suitable and achievable.
I just thought of another question that I always get.
What?
So what do you charge me for your renewal, for looking at my renewal? I get that a lot, and I want people to understand. They're always a little surprised with my answer. It's part of being part of the Meta family. We do get paid when the mortgage closes, so the advice we're giving you on where to go, that is essentially free to you if you're staying where you are. But if you stay where you are, at least you're still part of our family. We'll be there to help you service the mortgage and help you in the future. So that is just kind of a courtesy service that we do, just to make sure you're well taken care of and that you're set up for your future goals.
Yeah, we've as a part of the family, we're not a transactional type of brokerage. We're looking for relationships with clients. We've always said that from day one. And that's reciprocal, right? So if a client is saying, "Hey, you know what? Can you have a look at this for me?"
Yeah.
We're gonna put the effort in it, and we're gonna look at it objectively and provide that advice. If it makes sense to get better somewhere else and it has to mathematically make sense, we have the calculators to do it, and we display it to the client. Then transparently they'd say, "Oh, okay, this makes sense. Yeah, I'd like to do it and move forward." And that may mean making a change. And if it does, it does. If it doesn't, then we will tell the client straight up that it doesn't. But at the end of the day, they're going to get a fair shake. So yeah, people do ask that. We've never charged a client for a maturity review at this point. And for the most part, people are fantastic. They've always valued our time really well, and have maintained that relationship. So that's been good.
Okay, great. Let's switch over to the purchases side.
Yeah.
We talked at length about maturities, purchases. So we mentioned last time that first time home buyers are back on the market. We are seeing purchases picking up. We're entering into the spring market, so we're going to see more things come on the scene in terms of inventory. This question I got so many times. Have we hit the bottom of house prices? When do we know we have flatlined and prices aren't going to go down anymore? Because we actually were looking at some stats earlier today on where house prices have gone, and they have gone down considerably. Have we hit the bottom? How do we know?
Well, hold on. Let me take a look at my
Crystal
crystal ball
ball,
hit.
just
Yeah,
dust it off.
dust it up. So no, I mean, here's interestingly enough, you just go by data, right? So today, we saw some data came out from the Canadian Real Estate Association saying that year over year, of course, prices in Canada have come down by about 18.5%. That's a huge drop. But remember, that's year over year. We have to understand that this time last year, we're pretty much at the peak, right? Like if we're like February, March, April, we're at the peak. So we're going to see the largest drops year over year right now than we would see in May or June or even in July. Okay, because prices started coming down already at that point in time. So, but what I would say is that if you recall, Nick on our team had done some analysis on data back in October and said that at the time, from pretty much it was the peak of March to September, prices were down about the 18 to 22%, depending on where we were looking. So now if we're saying year over year, we're at about 18.5%. It just shows that in the past 6 months, we've been pretty stable.
Yes, correct.
Okay, so probably some ups and downs here and there, but minor. So that to me shows a sign of resistance to the bottom.
Mm-hmm.
And so perhaps we're around the bottom, and now we're going to be entering into the typical seasonality of real estate, which is where demand starts to uptick once we hit April. And so now we may see prices start to tick up a little bit, right? So I think, I can't say that we have a bottom, who knows, but we can look at data and try and make sense of it. And that's how I'm making sense of it right now.
One thing that you've always said to me that always stuck, I've heard you say it to clients before too, is you can't time out the real estate market. So when people are asking, are we at the bottom? What they're really asking is it the best time to buy? Because they want to buy when things are the absolute lowest. So what they're really asking is, should I pull the trigger now or should I wait for prices to come down more? And that is a very tricky thing to time out. And we've seen people get burned waiting for the right time. So I think that's important to know. There's no real right time, and waiting for the market is really only one piece of a very big picture of what your plans are, your goals are, your dreams, and where your financial status is. So I think it's more important for people to stay on task of what they want out of life and make the market work for them. And that's where professional advice really comes in, because we've seen people buy and be successful at all different stages of this real estate market. We were crazy busy last year when things were at the all-time high, right? And that you would think that's the worst time to buy. People were buying then, people are buying now. And it's we talked about it last video. It's about affordability, what works for your budget and what's going to work for your future goals. So I think right now, knowing that we're pretty low, like there's even if we went down a little bit more, like I don't think we're going to go down 18.5% more. So
you know what you hit the nail on the head. I tell people all the time, it's not if you're buying the house you're going to live in, you cannot time the market. You got to find the right place for you and your family. And then when that right place comes along and you're pre-qualified, that means that it's likely your time to buy, because you have to live somewhere, right? So I feel that if you're buying an income property, it's a different story, right? And most people who are buying income properties, guess what? They've continued to buy through this. So ultimately they're buying.
They had a very different perspective on this. Interest rates were higher, but they looked at it as a business expense, right? So they were not as scared to go ahead and continue to invest. Whereas somebody who's looking at their own principal residence, they're a little more sensitive to it because it's very personal, right? People who have investment properties can really compartmentalize, and they feel at ease to say, well, if it doesn't work out, I'll just sell it. I'll just move on, right? You can't just do that with your owner occupied property.
But also true, but they're also in it for the long game. And so what people who are investing are consistently investing, and why? It's because they're dollar cost averaging, right? So if you look at if you buy a mutual fund or a stock and you're getting paid a dividend, you decide to reinvest that dividend. That dividend is reinvesting every time the stock is going up or down. And why they're doing that is because they're buying. When it goes down, they're buying on sale. When it goes up, they're still investing, right? So people who are buying income properties have continued to buy through the ups and downs because they are dollar cost averaging. They just want to continue to invest
Right.
because they're in it for the long haul. If you're buying your home, we have to think of it less like an investment, and we have to think of it as a place where we need to live. And that's really important. It's less of it's sure, okay, you're investing some money into it, but you're definitely having to keep in mind that you're going to live there. It's the place
Right.
where you're going to live. So you have to live somewhere.
Exactly.
So really important to find the right place to live. So we can't time the market is
Yeah,
what
we
I
gotta
always
look
tell
at the
people.
big picture. That's why
That's right.
having a pre-approval where we ask you some key questions is a good experience because it makes you think as well about what you really want and what you want to get yourself into,
Right.
and reevaluate your position. Whether you go forward or not is up to you, right? But at least it gets you thinking about the right things and maybe highlighting some things you wouldn't have thought about on your own without speaking to a professional. Okay, so I want to move on because I don't want to take up too much time, but we kind of were already getting into it there. We talked about the bottom of house prices. How do we know what's going to happen with rates? How does your crystal ball work, Vince? How are you figuring out what's going to happen with rates? I ask
Um,
that question a lot because I think people were very relieved to see the Bank of Canada leave things flat last week, that it made some people go, okay, so what's going to happen now? Does that mean we're going to start heading backwards? What triggers do we look at to estimate what we think is going to happen?
I mean, there are multiple triggers, right? I mean, the biggest reason why the bank didn't change is because there wasn't a massive growth in GDP numbers. So we noticed that maybe meant that the market was slowing, inflation was slowing.
Right.
But then all of a sudden the jobs numbers came out and they were through the roof. So perhaps we're going to see an increase. It'll be interesting to see what the Fed does in the US next. But I can say, look, the bond market has come down, has softened. We're seeing fixed rates come down. That's probably has a lot to do with what's going on in the US and some of the
Okay,
bank
you
issues
just
that they
took the
have.
words out of my mouth.
Um, so yeah, not that I really wanted to talk about that, but at the same time, it's real, right? That's what's going on right now in the US, and so that affects everything, right? Canada is a very small market when in respect to the US, so whatever happens in the US affects us
Trickles
greatly.
here usually, yeah.
Yeah, it affects it globally. So we've seen bond yields come down. So for now, at least in the short term, we're going to see fixed rates come down, which is good for everyone who has, either a pre-approval or whose mortgages are coming up for maturity. So
Right.
let's keep that in mind. We're seeing that happening.
Yeah. It's funny you said that about the US because following that video, a lot of people said, oh, what's going to happen now that these bank closures have happened in the US? What's going to happen here? And I
Right.
said, it's complicated. That's maybe a topic for another day because I feel like we could really do a deep dive on that. But I think the important thing to mention, like you said, is just that really whatever happens there, we do get a bit of runoff from that. So we're kind of watching to see what's going to happen.
Yeah, like we're keeping an eye on the indicators. I think what's important for us, like we just keep an eye on the pulse of the market. We have access to some really great economists. We have access to, some bankers out there. We also have access to the data that's available out there, and that's what we have to look at when making
Exactly.
these decisions. Yeah.
Yeah, that's great. So, speaking of price and rate, I had a couple shoppers say this. Even though prices have come down so much, they're looking and they're saying, "Oh, there's a lot more things I can buy in my price range versus a year ago or so." But we still think it's too expensive to buy because the interest rates are higher. How do
Mm.
you know you've balanced a lower price with a higher interest rate and basically you're getting a good deal? How do you offset that to know that you're making a smart move?
Um, Comes down to affordability. It's the most important thing. I mean, the number one thing is you got to do your budget. You got to know where you stand, what you're comfortable paying, and then we cross-reference that with qualifying you based on the budget you can handle. And if you can qualify and it falls within your budget, then forget timing things because you can't do that. Just
Yeah.
can't.
The one thing I did say to a few people who asked this question or a similar question, or just the conversation went that way, I mentioned that we're looking at interest rates today for this term. Don't
Right.
let this term prevent you from making a lifelong decision, right? Because a term is very short. Like
Right.
a lot of people right now are going into shorter terms if they want to go fixed, maybe 2 or 3 years. So yeah, they're paying higher than they would have paid a few years ago. However, it's one term. They will have always purchased that home at a lower price. So
For sure.
I've had to kind of focus less on what that interest rate number is, because at the end of the day, it's only going to last a short period of time where you will have always paid that lower price for that house. And the important thing is that your monthly income is comfortable to cover that mortgage payment. And that if you've told us your max payment every month is $2,000, then we've made sure when you purchased that with the interest rate you're getting today, your max payment will be $2,000. So that may work out to, if rates come down in the future, some savings,
Yeah, I mean,
right?
or you just double down and start paying the mortgage off quicker, right? So
Exactly.
yeah, people definitely need to work on getting to know their numbers. It's really, really important. I think clients, we force them to get to know their numbers and ask them. I don't like the I don't know answer when we ask what payment are you comfortable paying. That's a
Go
little
back
bit
to
of a
the
red flag.
chalkboard.
Yeah, a little bit of a red flag there. If someone says I don't know, especially in this day and age right now with where rates are, it's really important people are comfortable, and that they're not biting off more than they can chew. But a lot of times people um don't know how much they can actually bite off and chew as well, because maybe they haven't been there yet before, right? So because they lived with family or they've never really had the responsibility of a mortgage payment. So oftentimes, we've done this before. We've told clients, listen, let's simulate this payment and you just start saving this amount that you'd be paying every month anyway. So if your payment's going to be $2,500 a month or $3,000 a month, start saving that every month and see how easily you can save it. And if you can save it easily and still live, then you can afford a $3,000 payment.
Right.
But if you're struggling, then you're going to struggle, right? And that struggle will be real once you're in the house. So um, bottom line, it comes down to affordability, just to answer your question. Yeah.
I've said to people, don't hang up on that one indicator. The interest rate is only one piece of a lot of terms in your mortgage and a lot of things that go into why you purchased a certain home. It's one piece and it's got an expiry date. So you shouldn't hold off your plans
Absolutely.
forever. And speaking, this is why in our last video we talked about why first time home buyers are coming back, because first time home buyers a while ago told me, like, hey, we're going to hang out for a bit and see what happens. Continued to rent, and rent's going up and up and up, right? Because their landlord's payment is going up and up and up.
Yep.
And they decided to wait, and finally they came back and said, like, I've had a handful buy in the last like 2 months, who came back and said, we want to look at it again because it's crazy. We're still spending on rent every month. We see these prices come down, but we're still afraid because we don't want to take on a 6% interest rate or a 5% interest rate, because
Right.
we started this process when things were 1.5, 1.75, and that sounded so great. It's kind of a little bit like disappointing to change it. And we tailored those conversations to affordability and what they could afford every month. And those people have been successful in buying because they were able to take advantage of the lower prices out there.
Yep.
So yeah, I think that's great. The last thing we wanted to talk about, we talked about reverse mortgages last time, and we very quickly covered it because it's something that we've started seeing trickle up. We've done a few already this year. We've seen a few new lenders come into the market, and our team's gotten more educated on it this year. And we said, oh, we'll save that for another day and do a video. But we had a lot of people comment on reverse mortgages,
Yeah.
just saying, yeah, I'm looking forward to that video. Not really a lot of specific questions, but a lot of people that just had a bit of a taste to get to know more. So that's exciting. Have you gotten some questions about
Yeah.
reverse mortgages?
Yeah. And I mean, it makes sense, right? It's this right now, from what I can see, it's about a $6 billion market in Canada. And the demand has been up, according to one of the lenders, 20, was it? No, 30%, almost 30% in 2022, year over year from 2021. So there's definitely a spike in demand and curiosity around the product, and got some questions and people who want to have some side conversations. So we'll do that. And what we'll do is we'll definitely set some time aside, Cass, to go through it in detail for people so they can educate themselves on the benefits of the reverse mortgage and see if it's suitable for them or if they want to have a further conversation in the future.
Yeah, I think that we will record that video soon where we'll go through some questions and how it works, how you calculate it. But I think because, I mean, most people that are in that baby boomer age, they still have a mortgage, but a lot of them aren't working anymore. So they're really feeling that pinch with everything else going up, gas prices, groceries, just daily living expenses have gone up, that a lot of people who were a little scared of the reverse mortgage before because of some of the
Right.
misconceptions shied away from it. But I think sometimes people need to be put in an uncomfortable position to open their minds a little bit to hear
Always.
about these things. So I
Yeah.
think that's why we're seeing a bit of an increase in curiosity around this particular product. And I love this product. So I am very much looking forward to filming that one. So I just wanted to bring it up today to reiterate to people we are definitely going to have that deep dive discussion on that. And we are happy to run individual scenarios with individuals if they want to reach out and see if the product's right for them before that video comes out, in case it's, a couple weeks before we're able to do that. Because I would love to fill in some people on what this product is like, because I've seen it change lives a few times this year already. So
Sure. Yeah, I know it's definitely an impactful product, and we'll be looking forward to doing that. But a lot of good questions. Cass, was good. I thought we put that video together, and you put it out there, and all of a sudden, yeah, we got the email blew up, and we saw a lot of questions. So it was really good.
yeah.
Happy to answer those questions and any more that people have. And I know you'll continue to put me to task here on the
Yeah.
questions as they roll up.
Yeah, it's yeah, we're always open to questions, and I think it's great that we have such a loyal client base that is very comfortable to email us and say, "Hey, you mentioned this," because everybody can benefit from those questions. So I want to encourage
Yep.
people, if you see information on Instagram or on our YouTube or in our newsletter or whatever, or something you've heard out there and you just want to know what the deal is, to reach out, because clearly you and I could talk about this all day. But
This was supposed to be 10 minutes, Cass.
I
Look
know
at that.
this was going to be an Instagram video. I think it's officially a YouTube video now with maybe some clips on Instagram.
We
But
can break it up. Yeah.
yeah, that's okay. I'll do some editing and work it out. But
Cool.
and I think too, we can't hit everything in a video sometimes because we are so used to talking about these things. We don't always think things from the client perspective or what they might ask. So it's important to do these follow-ups when people do have questions, and we will address them if you ask questions. So drop us a note.
Yeah, or even sometimes people will send a text or an email, and then I'll just say we just need a phone call quickly. It's just easier over the phone, but it's
Right.
good to see the curiosity and the questions where they're from, and then you can have a better conversation, more tailored discussion over the phone or over Zoom with a client directly, right? So yeah, keep them coming, guys.
Yeah. Okay, awesome. Thanks, Vince. I'm going to let you run since we
Right.
are officially 35 minutes over our meeting
Woo.
time.
All right.
Have a great night. Thanks,
Yeah,
guys.
thanks.
Bye.
Yep, bye.